Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at Meta and Amazon stock ahead of their upcoming earnings releases next week as we get into the thick of big tech earnings to consider if we should buy these two big tech giants before earnings or possibly wait for more selling. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So to start the week on Monday, we saw some of the recent retreat halted with the NASDAQ, the S&P 500, and the small cap Russell 2000 all surging to start the week. The bulls showed that they were kind of ready to fight and not give up the cause before big tech earnings season really heated up. And then reports came out from Alphabet and Tesla after the bell on Tuesday. And in disclosure, I'm recording this mid-afternoon or right around midday on Wednesday. So at the moment, we saw those reports kind of spark some selling, and it kind of seemed like more selling was due amid big tech earnings. So as I record this, the NASDAQ's down about 2.7%, so a big pullback with Tesla stock down over 10% the last time I looked, in Google. So Alphabet shares, Google shares down around 5% the last time I looked. So overall, yes, the big midweek market pullback that finally took the NASDAQ below that 50-day moving average as I'm recording this for the first time since the middle of April, which was the first time in 2024 that the NASDAQ fell below that key moving average, as the 21-day had kind of been the line in the sand. So a pullback was due. At some point, we got way above the 21-day, and we got to some of the most overheated RSI levels, so overbought RSI levels. Over the last year, we got all the way up to 81. Anything above 70 is considered overbought. And now this big pullback has already taken us almost down to oversold. So depending how things shake out in the next few days, we might see some buyers step in. That said, we are still trading solidly above the NASDAQ's 21-week moving average, which is that longer-term trend line. So we could see just that be the next possibly line in the sand the bulls will hold, either the 21-week or the 200-day moving average. That said, by the time you're listening to this, maybe some buyers stepped in around the 50-day. Overall, though, it's good to see some selling heading into the thick of big tech earnings because the market was just due for a pullback at some point. And it is worth noting that there could be more selling and more volatility throughout earnings season, since big tech stocks had set a very high bar for themselves to cross. Thankfully, though, the tailwinds that drove the market in the first half, namely the outlook for interest rate cuts and overall really impressive earnings growth, especially from tech, remain in place. So any near-term selling continues to mark kind of a healthy recalibration for the market and an opportunity for both near-term and longer-term investors to buy some of their favorite stocks at a discount. So with that in mind, we're going to take a look at the first of our two stocks today, and that's Meta Platforms, which trades in the ticker META. So Meta, their Q2 2024 earnings are due out on Wednesday, July 31st. So Meta stock is down around 13% at the moment as I record this on Wednesday. Heading into that earnings release, yet it's still up around 30% year to date and almost 400% off its 2022 low. So let's dive into all things Meta. So rising rates and Wall Street's huge pushback against its metaverse bet forced Mark Zuckerberg to quickly pivot back to its core competencies, cut costs, and really focus on the bottom line. And that's kind of been the story over the last few years. So Meta's various apps still remain kind of the core of social media and digital communication. The firm stands to benefit really from the never-ending need for advertisers to reach people where they are, which is on their smartphones and on these apps that Meta is still kind of the dominant player across those. So through Facebook, Instagram, and WhatsApp, so those are its big family of users, they were up 7% in the first quarter of 2024 to 3.24 billion, with ad impressions delivered across its family of apps up 20% year over year. And the price paid per ad was up 6% year over year. So still, it's a dominant player in this space that's not going out of style anytime soon. Advertisers continue to try to reach people where they are, especially as everyone's on their streaming TVs without as many ads these days in a world of smartphone addiction, which is hard to see kind of ending anytime soon, barring some massive change that Meta's core business is still going to be massive. It's reaching over 3 billion people daily, as I said. And on top of that, it's now investing in its AI future. So not just this metaverse bet that people didn't really seem to think it was going to be a great idea. So now they're introducing their own generation of AI chips alongside the likes of NVIDIA and others. Meta's goal is also to lead the AI race through its open source tech. So a Wall Street Journal headline recently read that, quote, Facebook's parent plan to win the AI race, give its tech away for free. So this is also from the story, behind the contrarian strategy is a bet making Silicon Valley's hottest new technology free will drive down competitors' prices and spread Meta's version of AI more broadly, giving Zuckerberg more control over the way people interact with machines in the future. Meta, in a note by Zuckerberg himself just on July 23rd, said that open source AI is the path forward, citing open source Linux and how it gained popularity versus its rivals and became kind of the industry standard and the foundation for both cloud computing today and operating systems that run most mobile devices. He wrote that, quote, today we are taking steps towards open source AI becoming the industry standard. They are releasing their latest version of what it calls its Llama open source AI model. In quote, addition to having significantly better cost/performance relative to closed models, the fact that its new open source AI model will make it the best choice for fine-tuning and distilling smaller models. So Mark Zuckerberg and Meta's bet is to go a little bit in a different direction than all of these other AI companies by rolling out an open source platform that they see as a way to kind of create dominance in the space going forward for years and possibly decades to come. The firm is committing billions to fuel its AI bets alongside really everybody else in the big tech space in this new tech arms race. And it's something that Wall Street's definitely keeping an eye on, but its plans for spending are not crazy outside the lines of what everyone else is doing, especially as you have to get in this space now if you don't want to get left behind. So let's dive into a little bit more of its recent growth and its outlook. So Meta is a digital advertising titan, dwarfing smaller competitors such as Snapchat and Pinterest and everything else. I remember a great quote that I read, I don't know, maybe even a year ago at this point, that essentially Meta is the place to advertise. So this is across Instagram, Facebook, WhatsApp, and everything else. And that then Snapchat and Pinterest and places like that kind of get the leftover, the table scraps, kind of like your dog at the dinner table. So Meta's revenue is projected to jump 18% in 2024 and 13% next year to go from 180 billion in 2023 to get to 180 billion from 135 billion in 2023. So a massive jump on the top line. It's also projected to grow its adjusted earnings by 36% in 2024 and then another 14% in 2025, which is following 73% bottom line expansion in 2023. Its Zacks consensus estimate for 2024 in terms of earnings is up 23% over the past 12 months and 21% higher for 2025. It has also crushed our estimates in the trailing 4 quarters. That said, its earnings outlook has stagnated a bit recently, so that's why it grabs a Zacks rank number 3 hold at the moment. Overall, the tech giant's balance sheet is really impressive. This is helping it get into its AI bets. It had about 58 billion in cash and equivalents, 222 billion in total assets versus 73 billion in total liabilities. And it confirmed its commitment to shareholders earlier this year when it finally initiated a quarterly dividend, which kind of shocked people. It's not paying a big yield at the moment, but it is showing that the company is now really focused on returning value to shareholders, buying back more stock, paying a dividend now, and focused on the bottom line more than ever, while also rolling out its AI bets. Wall Street's really high in the stock overall, with 39 of the 45 brokerage recommendations that Zacks has coming in at strong buys. And then it's worth taking a look at just how the stock's done. So the stock's up about 400% off its 2022 lows, including a roughly 30% year-to-date surge. That said, the stock's down over 13% from its early July highs, and back below that 50-day moving average. It got rejected there again recently, and now it's trading slightly near oversold RSI levels. And then if we look on a longer term timeline, it's now back below its 21-week moving average and roughly neutral RSI levels. So if you're a longer term investor, maybe you want to wait for a little bit more of a pullback. Maybe it gets back to that 50-week or the 200-day moving average, but it is certainly cooled down a lot rather quickly, along with much of the other big tech sector. So despite that rebound and its roughly 530% climb in the last 10 years, which easily tops the Zacks tech sector, which is up around 310%, its valuation is really impressive. It's trading at a 20% discount to the Zacks tech sector, in 63% below its own highs, at about 22.4 times forward 12-month earnings. Meta's recent cool down alongside the market helps the stock potentially be more appealing to long-term buyers and investors who can maybe weather any near-term volatility heading into earnings. Obviously, earnings season is kind of a hit or miss thing. You never know exactly how the market's going to react. Maybe the reactions to Tesla and Google show that they're going to be some pressure on a lot of these tech stocks, and maybe investors take profits kind of no matter what happens, since, as I said, there is such a high bar to set. So depending on your risk appetite, maybe you want to buy the stock before earnings to see if it possibly pops. But if you're a longer term investor, maybe get in now and kind of don't care if it falls a little bit more. And if it does, if you're a big fan of Meta stock and it falls after earnings, buy some more, because playing the market timing game exactly is very difficult. So overall, though, Meta seems to be a nice longer term bet on AI and the broader use of smartphones and social media for years and years to come. And now we're going to move on to Amazon stock, which trades in the ticker AMZN. It reports its Q2 2024 earnings results on Thursday, August 1st. So Amazon shares are up roughly 20% year to date and around 120% off their lows. That said, the stock is down around 10% from its highs heading into its report. So let's dive into everything that's going on with the company and the stock. So like with Meta and lots of these other big growth tech companies, higher rates really in slowing cloud growth at the time forced Amazon to reevaluate a lot of their business. It hit the stock hard in 2022, and the higher rate environment forced Amazon to focus on profits and maximize efficiency under CEO Andy Jassy, who took over roughly 3 years ago at this point from former CEO Jeff Bezos. Amazon still runs the world's largest cloud computing business, and cloud computing is going to be a key pillar of the modern economy, and it's only really growing in importance. And the combination of steady cloud computing growth and concentrated effort to boost earnings now and going forward is kind of the pitch that breathes new life into Amazon stock, and likely will going forward. Amazon reportedly held roughly 33% of the cloud computing market last quarter versus Microsoft's 22% and Google's 11%. It's attempting to improve its cloud computing margins by rolling out more in-house chips. It's also actively rolling out more AI-focused efforts to attract customers to spend more as everyone races to not get left behind. Its CEO touted recently that the AI revolution It's continuing to roll out the AI revolution that it sees while also cutting costs. That's Meta's pitch to people as well, streamlining the business while not getting left behind in AI. It's planning to spend more than $100 billion over the next decade on data centers, which is a really impressive level of investment for a company that had been known for its spending ways. So even though it's been spending a lot, that's a big number. And it's now going to be reportedly devoting more investment money to its cloud computing and AI infrastructure than it is to its sprawling e-commerce warehouse network and all of that. So that's going to be kind of the new growth. It has been the margin business for a long time and a big part of the business, but they're going to be spending a ton in the coming decade on their AI business going forward. So far this year, Amazon Cloud business is up roughly 18% compared to roughly 13% growth this time last year. And then on the e-commerce front, it's continuing to benefit from its transition to a single national fulfillment network. And it currently holds roughly 40% of the total e-commerce market in the US, blowing away second place Walmart. It's also growing its digital advertising segment, which could be key. The segment climbed to 24% year over year in the first quarter, which marked its largest year over year gain by any of its divisions that actually account for a big portion of its revenue. It's also aiming to boost its Prime segment by rolling out more live streaming entertainment efforts, especially sports, which is going to help with its advertising business and help customers continue to be Prime members, which is a big part of their business as well. So looking ahead, we're calling for roughly 11% revenue growth in both 2024 and 2025 to go from around $575 billion in 2023 to all the way up to $710 billion next year in 2025. And then on the bottom line, we're calling for 58% adjusted earnings growth this year, and then another 27% adjusted earnings growth next year. So really impressive bottom line expansion. And its earnings outlook has improved significantly over the last year. It's up about 103% for 2024 and about 70% for 2025. So trending heavily in the right direction. And that bottom line positivity helps it land a Zacks ranked number one strong buy at the moment. And then to get back to its stock price, Amazon has slipped roughly 10% from its recent all-time highs, and it's trading around 22% below its average Zacks price target, yet it's still up around 120% off its lows. The stock has climbed over 1,000% in the last 10 years. This blows away tech, which is up around 300%, tops Apple, which is up around 800%, and really crushes Alphabet/Google, which is up around 480%. Yet it's down around 1% still in the last 3 years, having failed to break out meaningfully higher above its all-time highs from 2021. So that recent pullback from those highs kind of topped it out from getting too far above its previous records. That had been kind of the line in the sand that it couldn't get above several times so far in 2024, and then it finally broke above that, and now it's right back below those 2021 highs. So as I said, the stock's down still 1% in the last 3 years, despite that massive climb off of its lows, which actually should be a positive to investors who maybe missed out on this ride in the long run. So Amazon is now trading right at its 21-week moving average, and it fell from heavily overbought RSI levels to roughly neutral on that 10-year time frame. It's also now trading below its 50-day moving average as well, and near oversold RSI levels on that 1-year time frame. And then on the valuation front, it's looking really impressive. It's trading at a 95% discount to its own highs, 50% discount to its 10-year median at around 35 times forward 12-month earnings. This is actually near its lowest ever levels, showing that it's really rapidly improving its earnings multiple is helping, or that its rapid expansion of earnings is helping improve its earnings multiple. It's committed to streamlining its operations and continue to churn out profits. So that should be a reason for investors to be happy with Amazon's valuation going forward, and its AI efforts, in the fact that it's a cloud computing giant, stand to have it profit from the broader AI supercycle kind of no matter what. And it's continuing to benefit from its e-commerce and retail business along with that growing advertising segment. So certainly worth putting Amazon on your radar heading into its upcoming earnings release next week. And like with Meta, depending on kind of what your risk tolerance is, maybe you want to buy on the dip heading into earnings or wait for a possible bigger pullback like we've seen with Tesla and Google following their earnings releases, just given how much tech had climbed in the first half of 2024. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.